Central Bank of Kenya reduced the base lending rate for the first time this year since January by 100 basis points to stand at 8.5%, sending a strong signal to commercial banks to lower their lending rates in order to jumpstart the economy. Beatrice Gachenge brings us to speed on the implications of this reduction.
High interest rates in Kenya have been a sore subject for the business community, leading to a slowdown in economic growth in 2012 of 4.7%, affecting capital-intensive sectors such as real estate, manufacturing and trade. However, the 1 percentage point cut in the central bank rate is a welcome move and is expected to unlock credit for the entrepreneurs.
Informal sector is the one which is actually driving this economy. Sometimes we think it is the multinationals, but it is the informal sector that is driving this economy. So, given the interest rate, the lowering of the interest rate is likely to encourage those small borrowers to be able to borrow, because now the money will be affordable. The cost of finance is low, so it is affordable, and therefore they will borrow. As a result of the borrowing, then we expect that sector, which is a major sector in this economy, to really do well. And if it performs, the economy performs.
Since CBR was cut, then it means banks can ideally access money at a lower price from the central bank as the lender of last resort, or a lower CBR should ideally translate to lower rates in the interbank market, meaning that liquidity in the market, overall liquidity will have improved, meaning that banks will not be willing to pay a high cost for their deposits, meaning that now your asset manager who was earning high rates from last year on their fixed deposit accounts will no longer have that option, because bank will not renew those high rates. So they have to put the money somewhere, and if you do a trade-off between risk and liquidity, then the money markets, despite offering lower rates, remain attractive.
Entrepreneurs like Charles Wambogo, a building contractor, put some of his plans on hold on account of high interest rates last year.
I can remember there's a job I attended for, and you actually qualified for that job. But now the owner of the project looked at the interest rates that went up, and they decided that they don't really need to do that job then. They can wait, and for us, when you lose that one job, you don't know when the next one is coming.
Now he can sigh with relief. The ripple effect of affordable credit is expected to propel business more so at the grassroots level, which account for at least 50% of the country's GDP.
I see a scenario whereby people will be able to borrow more. And as is the norm, nobody wants to spend so much of their own money. Someone would rather spend half in putting up a structure and borrow the other half. With the interest rates having come down, more people will want even to do alterations in their houses. People want to change the way their houses look. They'll want to do extensions.
The Nairobi Securities Exchange, which has been bullish this year, adding 15%, also hopes of gaining more impetus.
The signal they read is that, well, look here, we are stabilizing. This is a more certain environment. It's a good investment destination. So most of them would like now to put their money in a market like that one. In a market like that one, where while else you find that they want high interest, because the foreigner or any other investor wants to where he can get maximum returns.
Dollar inflows from foreign investors into the bourse is forecast to help ground the Kenyan shilling against the greenback.
Manufacturing companies that have been looking to expand or increase their output, now they can go to the banks and borrow, ideally at a lower rate. And then the same banks that actually were expanding the private sector credit by over 30% in 2010 and only 7% last year, now they can start lending more. So meaning your manufacturing companies have access to credit, they can expand, revenues increase, their margins perform better because you're using gearing to expand. And then when it comes to the banks, they're lending more in terms of volume of business, therefore their profitability also increases, therefore also has a positive impact on their earnings and therefore the price performance.
Banks, however, stand accused of failing to keep up low interest rates in tandem with the central bank rate, with the lag taking longer than expected to feed into the economy.
If the interest rate is high, people are unable to pay the loans, because again the cost goes up, So the amount of money you are supposed to be paying goes up. So people are unable to pay their loans. So the loan becomes non-performing if the interest is high. They are also saying we are charged high because some of you will not pay, and therefore we get it from those who you are paying. So as a result, that less premium cuts in both ways. So when you look at, despite the fact that the central bank is trying to give the right direction, the right messaging, the banks always are reluctant to follow suit.
East Africa's biggest economy, Kenya, is expected to take off on the back of the passage of peaceful elections, coupled with easing of monetary policy. This is despite the central bank pointing out that the widening current account deficit would pose a risk going forward.
The fact that now there is political stability, because Kenya now is looking up, we are obviously very optimistic. In terms of interest rate, the central bank is giving the right message, reduce the interest rate, and therefore more people can borrow more. Then we expect the economy to grow, the economy to grow better. To me, I have no doubt it should be better than last year.